and welcome everybody. Thank you for joining the updates on Time Finance. We'll be progressing through a number of slides. I will give everyone an update on where the business is at strategically against our plan, and James will cover off the numbers, both touching on our last financial year to the end of May, but also a more recent update to the end of the first quarter at the end of August. So next slide. So just by way of introductions, I'm Ed Rimmer, Chief Executive of the business. I stepped into that role 2.5 years ago now. I spent 25 years or thereabouts in the financial services sector, lending to small businesses. I think it's fair to say I've seen probably 2 or 3 key points in time where the businesses that I've been in have been through downturns, and I think we're probably in one of those situations at the moment where there's lots of good opportunities for alternative financiers like ourselves. But I'll come on to that as we go through the presentation. James, do you want to give your introduction?
Thanks, Ed. Good afternoon, everybody. Yes, James Roberts. I'm the CFO, and I do have another jumper. I just realised I'm wearing the same jumper as I was in that photo, so I need to get myself some different clothes. I've been with Time Finance since 2017, so just over 6 years now, and I've got about 20 years experience in financial services, working with a variety of companies, some on AIM, some early stage startups, some global companies, some on acquisition trails, etc. So, but the last 6.5 years have been with Time Finance.
Thanks, James. I appreciate that a lot of people on the call may know about the business. I think there was about 2/3 of people said they were already shareholders, but that probably means that some aren't. So we have just got 2 or 3 slides in terms of who we are, what we do, and how we compete. So I'll try and sort of whistle through those because people will have potentially seen them before. So if we just move on to the next slide. So who we are and what we do. Well, we're an alternative financier. That means we're not a bank. We're an independent provider of finance to small businesses. We fund around 11,000 small businesses, typically those turning over very small amounts. So from startup, typically up to 5 or 10 million pounds. So we very much focus on the S in SMEs, as we like to say. We lend predominantly from our own book. That's become much more prevalent over the last few years. We do still have the flexibility to broker on deals if we wish. That's mainly in the asset finance division. And one of our key, we believe, differentiators is the fact that we provide more than one offering. So we provide a multi-product offering, which comprises assets, invoice, and loan finance. Next slide, please. Our key products are those that I've just mentioned. In terms of asset finance, we do soft and hard. The key differences are that soft assets typically don't have a residual value at the end of the lease, whereas hard assets do. So typical assets that we finance will be in the soft asset regime, catering equipment, gym equipment, could be literally tables and chairs for a cafe. In the hard asset environments, it's very much yellow plants, construction equipment, printing presses, those sorts of assets. Our introductory channels actually across all 3 products come from intermediaries, so very much into the broker market and professional circuit, so accountants, insolvency practitioners and the likes. Deal sizes for asset finance typically up to 750 million. We have just actually increased that up to £1 million, and the sweet spot tends to be around 15,000 for soft asset and around 50 to 100,000 for hard asset. But we are seeing some bigger transactions this year that we're funding. The typical yields, well, we don't write much business at all now at 8% since interest rates have gone up. Typical average is around 12 to 13 in hard assets. Soft asset is higher because the risk profile is higher, and we tend to get around 18 to 20% for soft assets. And our funding for that product comes from wholesale block funders, typically the challenger banks. Sorry, if we just go back to that, thank you. So invoice finance, cash flow finance, effectively an alternative to bank overdrafts. It can be disclosed and confidential in terms of the debtor arrangements, so they may or may not know of our involvement. I've already mentioned in terms of where we get the business from. Typical deal sizes, well, anything from 50k up to 2.5 million. Both of those tend to be few and far between. Our typical sweet spot is in the 250 to 500k mark, and yields are typically 10 to 20%. And our funding for that product comes from back-to-back facility with high street bank provider. And commercial loans, exactly what it says on the tin. We provide loans against typically second charges on properties. Again, introductory channels are from brokers and professional firms. We cap out on our loans products at 500k at the moment. Sweet spots typically around 100, 150. And the yields there, as you can see, 11 to 18. And the funding, again, comes from wholesale block funders. And we also run a high net worth loan note program. So just onto the final slide in terms of who we are, what we do, and how we compete. So if we could just move on to the next slide. Thank you. So we do compete against the banks, as well as challenger banks, alternative finance platforms, so more commonly known nowadays as fintechs, other quoted companies and private companies. I think it's fair to say now that the banks, they do have the product set that we have, but they're not really renowned for flexibility, speed of service, and personal approach. Whilst the private companies, they tend to have all those things, but they don't tend to have the range of products. They tend to be a one product provider. When we're not completely unique, but we are one of a smaller bunch of alternative financiers out there that is more unique in the sense that we have all those attributes. So we are flexible because we're still relatively agile and small. We do provide a really quick service. We're very personal in terms of our approach to small businesses, but we do have the range of products. And that's one of the key things, as I said before, that differentiates us from a lot of our smaller competitors. So that's who we are, what we do. Our strategic plan, probably a little bit more interesting, hopefully, for those of you who have heard those few slides before. So our medium-term strategy, we put this in place when I came back into the business 2.5 years ago now. So we've got about 18 months left to run on our current 4-year cycle. We set ourselves some objectives. You can see them there. The first was to become a nationally recognised SME funder within our sphere. So that's very much within our commercial finance industry. And that was because we changed the name of the business. We rebranded at the end of 2020 from 1PM. The business was previously called, to Time Finance. And getting that coverage and that understanding of what we do, who we are, and how we operate was really important, and we've made great strides with that, I'm pleased to say. The second was to more than double our gross lending book from where we were in June 21, 115 million, and we're right on target to do that. I'll come on to the results in a moment. The third was to achieve profits organically in excess of where we were pre-COVID. We've made good progress with that as well. And the last was to significantly strengthen our balance sheet, mainly through focusing on own book lending, and good progress there as well. So the next slide should take us on to some numbers in terms of the progress that we've made to the 31st of August, which is the end of our first quarter, but also to a bit of a comparison to where we started the plan at the June 21 point. So our gross lending book, it's actually just gone through 180 million at the end of October, so that's a bit hot off the press. You can see there that we've still carried on the growth from the end of our previous financial year, where we were at 170 million, and from where we were at the start of the plan, we've grown by over 50% from 115 million. So our journey towards doubling where we started is as I say, right on track. And we hope to get towards 250 million by the end of the 4-year cycle, which will be a great achievement. That growth has typically been delivered by the two key offerings, and that is hard assets, so the hard asset element of our asset finance division and the invoice finance division. Between those two products, they now make up around 70%, 75% of our overall book. And you can see there the growth. If we go from where we started the plan Both of those offerings have doubled effectively in size. So hard asset from 32 to 67, and invoice finance from 25 to 57. So really good growth in those two key products, and they're absolutely critical for our future plans in terms of continuing to grow those. Next slide, please. Some other key metrics that are really notable: the unearned income, so the part of our gross lending book that sits as income, that income that's locked into the leases and loans that we provide, is currently standing at 22 million at the end of August. You'll see that was 14 million at the start of the plan, so we've got another 8 million pounds that sits in within our book. Why is that important? Well, clearly it gives us more confidence around the earnings that we'll put into our P&L. As long as those leases continue to pay, then obviously the elements of income that's within our receivables comes into our profit and loss account. So that's a key part of our numbers that we are always analysing and interested in. The own book versus broked on percentage is another key metric. You'll see where we were 12 months or so ago, 87 versus 13. Prior to that, at one point we were at 75-25. We're now at 97-3. So very, very small amount of our business is broked on now. The vast majority of it sits on our own book. And that comes back to obviously the key attribute that I mentioned in terms of where we are now of growing our own balance sheet and the receivables that sit within that balance sheet. That's our key asset that sits on our balance sheet. So good progress there. And I'm pleased to say that the expansion and the growth has not been at the expense of deteriorating credit quality. You'll see there that whilst we've grown the book, the overall percentage of arrears has stayed fairly flat from where we were at the end of our last financial year, and it's significantly improved from where we were at 13% at the June 21 milestone. So we're really pleased with the mix of business and the quality that we've taken into the book over the last couple of years. Next slide, please. And so just before I hand over to James to cover off some more detailed numbers, just a few updates in terms of progress we've made in our plan. As I've mentioned a few times now, focus has been very much on core business. We did exit some of our non-core lending businesses. We exited the unsecured loans, the smaller loans product in December 22, and we also exited some of our non-core consumer focused brokerages. The last one of those was about 12 months ago, which was the mortgage brokerage in Cardiff, and we also exited last year in April the vehicle finance brokerage. So we're very much left now with an own book lending business to business to SMEs under 4 locations, Manchester, Warrington, Bath and Reading, for 3 key products: asset finance, invoice finance and loan finance. The business is much more simple than it was. We've invested in proven leaders. So a couple of mentions there. We took on a head of credit in asset finance, Paul Seddon, last year. He's been very instrumental in helping us to take on larger deals, structure those deals accordingly, both originate and exit some of those deals when we need to as well, if things go wrong, which they do inevitably in lending to small businesses. So that's really helped us on that journey towards looking at larger transactions. And we have expanded the sales team in the asset and invoice finance divisions. We continue to do so. If the right people come along, we'll always be opportunistic if we know people and they're proven performers. That's been one of the key reasons we've expanded the business as well. And we've developed our product offering, so we've continued to evolve the offering. At the start of April this year, just before our financial year end, we launched an asset-based lending product, and that effectively is knitting our offerings together as one offering. So rather than just offering assets, invoice and loans as separate components, we can now offer those as a one-stop shop for one business who needs to tap into all 3 of those or 2 of them in combination. And we've had some early success with those deals. That they're not high in volume, but they are high in value in terms of the size and the returns that we're able to get. Our secure loan offering was launched in Q2. So as we moved away from offering small unsecured loans at the end of last year, we moved more towards secured lending, and that typically is against second charge on properties, and it allows us very much to enter that ABL world, which I've already mentioned. And the elements of the business that we have got left that's probably smaller at the smaller end is our soft asset finance. Most of that business, 85 to 90% of that business this year, has been done under our fast track offering. So that's basically making sure that we get the right business through the door. There's 4 to 6 key metrics that we credit score, and it goes through a system with less manpower attached to it, so it's much more efficient, and that's working really well. It's a smaller part of the business, but it gives us a higher return, and it gives us a little bit of natural risk away from just the hard asset and invoice finance. And we've continued to build our brand. The last point I mentioned, after we rebranded to Time Finance at the end of 2020, we've had a significant increase in PR, as you can see there. Last year, 26% increase. We sponsored the National Association of Commercial Finance Brokers, who most of our key brokers are members of. And we won quite a high-profile award in our industry, the Asset Finance Provider of the Year in 2023. So all going in the right direction in terms of our 4-year plan. I think at that point, the next slide is over to James. So I'll hand over to James.
Thanks, Ed. Yeah, so I'm just going to rattle through 3 or 4 slides, hopefully bringing the numbers to life and adding a little more context to them. There's 2 sets of numbers, really. One was the annual results to the end of May. Those are the last audited numbers we produced, and also the Q1 trading update to the end of August. So 2 sets of numbers to run through. I'll try and be brief to allow for more questions at the end, but some of the points are quite pertinent, I think. So this side here shows the key numbers for the business for the year to the end of May. As I said, the last audited set of numbers we produced. And as you can see on the right-hand side, a lot of nice ticks, which is always a good thing to report on. If we start at the top, own book origination was up about 14% to just over 73 million. And why is own book origination important? For our business, this is the lifeblood of the business, really. It's the number of deals we get sight of and we write and put on our own book. That in turn will lead to an increase in the size of our lending book, and due to its compound nature of how the interest is earned, should in turn lead to significant increases in revenue and in turn profit, as long as you get the right type of deals in. So if our own book origination is going up, that implies that the future is rosy to a degree. So own book origination up 14%, almost 10 million. So really pleased with that number. And that did lead to the increase in our own book lending book, as I implied. We topped 170 million at the end of May, which was 24% up on the end of May 2022. As we said, as Ed said, we started this 4-year plan on 115 million with a view to hit in excess of 230, more than double of it. And at the end of May, we were well on course, and I'll come on to talk about where we are now. Ed touched on the dealers in arrears, and why this is important is somewhat facetiously, it's relatively easy to lend money. The skill is to make sure you get it back. So we could be growing the book, but putting low quality deals on, which could be storing up trouble for the future. If the level of your arrears are steady or falling or whatever, that implies the quality of your book is actually improving. So we grew our book in the last financial year by 24%, but the level of arrears as a percentage fell by 14%. So from just over 7% to 6%, which meant that the quality of the book was arguably better than it was before. So we were putting good levels of new deals on, but we weren't seeing an increase in deals going wrong, which was particularly pleasing. And that fed through really to the statutory P&L and balance sheet. Our consolidated net tangible assets up by just under 4 million to 34 million or so. Our revenue for the period over 27.5 million, that's 17% up. And a couple of more startling figures perhaps was our profit before tax was up nearly 300% to just over 4 million, and our EPS also up nearly 300% to 3.73 pence per share. So all the metrics for the last financial year going going in the right direction, which was really pleasing. And if we skip on to the next slide, if that's possible, the first quarter of the current financial year, so from June to August 23, we've seen that trend continue, which was again really pleasing. So comparing the quarter to August 23 to the quarter August 22, we can see revenue, own book origination was up nearly 30% to over 20 million. The lending book, as Ed touched on, continued to increase to over 175 million. And at the same time, those arrears, and apologies for labouring the point, but it's very important as an own book lender, those arrears stayed flat at about 6%. That led to further increases in net tangible assets. We topped 35 million at the end of August. Revenue 7.6 million, and PBT 45% up on the 3 months in the year before. And bear in mind the figure I just mentioned, that the year before increased by almost 300%. So to see that 45% increase on that 300% figure is we think very pleasing. And you may have mentioned for those who follow us, earlier this week we did put an upgrade to market expectations out as well for the current financial year. So the market were expecting about 5 million, and we've said now it'll be no less than 5.4 million profit. So that growth in profit, all the metrics continue to point in the right direction, which has enabled us to put that very recent upgrade out. We move on to the next slide, if that's possible. I've said, as you know, it's key as an own book lender. The balance sheet is absolutely key, and so just a couple of stats on the balance sheet here. The table on the left shows the growth in the net tangible assets, and that's driven because we have remained profitable despite COVID and the macroeconomic headwinds. We have always remained profitable, and now as we've properly coming out of the COVID period, those profits are beginning to ramp up significantly. But even in the dark days of the middle of 2020, we remained profitable, which we think it shows the robustness of the business to weather pretty much any storm. The lending book has grown. We've touched on that, so you can see each year it fell to the low at May 21 at the height of COVID of 115 million, and then it's been on its way up ever since. And the graph on the right shows the level of arrears. I keep going on about them, but they are very important. What this shows is from January 2019 all the way through to the end of August, we can see the left-hand third showed that, I suppose, the typical level of arrears this business had pre-COVID. And then about a third of the way along, you can see some pretty big spikes, and that was the impact of COVID. The difference between the green bars and the purple bars are arrears, deals going wrong. The green bars are forbearance, and this is where clients have picked up the phone to us and said, look, we're in a little bit of trouble here with COVID. We need some help. Can you work with us? And we'd maybe let them off some interest payments for a few months, or maybe even some capital repayments, or restructure the deal to see them through that period. So you can see that the deals that weren't going to plan in the middle of 2020 spiked at over 40 million. Pleasingly, that forbearance, the green bars have gone completely now, and they have been gone for some time. And you can see for the last, getting on for 2 years now, the level of arrears have plateaued below 10 million. There's a few odd ups and downs, but generally very static over that period, despite the book growing significantly, as we've touched on. And you can see they're considerably lower than the left-hand third pre-COVID. So the quality of the book is arguably a lot cleaner and a lot better than it was pre-COVID, despite the significant growth in size. So some key metrics there, which are quite pleasing, we think, when we look at them. And then the final slide for me, if we can jump forward, show some other metrics and the impact the lockdowns had on us, and how since August 21, the book has grown pretty much consistently month on month. You can see on the left, pre-COVID, the book was between 140 and 150 million. Then whenever there was a lockdown, there was a big decrease in the book, either through us moving clients on to maybe some government funding, or people just stopping borrowing. Every time the lockdown ended, there was a little bit of an uptick, and then another lockdown would happen until the middle of 21, which we were at a low point of that 115 million we've touched on. But since then, and the doors are fully back open in the economy, we can see it's consistent month-on-month growth, almost for a whole 2 years now. And the book was at 175 million at the end of August. As Ed touched on, we have broken the 180 million barrier now, so that growth has continued. When we update this in a few months, that onward spiral will continue, which is great. We've increased the average deal size of our lending, but at the same time, we've continued to focus on spread. So no one sector of our book is particularly heavy. The top 10 sectors are less than 30% of the book. So we can see we're very well spread and very well diversified, which we think is very important for a lender like ourselves, so that we're not impacted in one area particularly. We're incredibly well diversified. We think we've got a sensible approach to provisioning. We've touched on arrears not increasing, and our bad debt provision has continued to be at about 3% of the net book exposure, which we think is sensible for where we are, and has seen us comfortably through the COVID downturn. The majority of our interest rate rises have been passed on to our clients. In invoice finance, we are able to pass on automatically every interest rate rise, so we're not exposed to interest rate rises. And in asset finance, our lending and borrowing is fixed on deals done, so the only interest rate exposure we'd have is on new deals, which we invariably would pass the interest rate on before we get the funding back. So we're not hugely impacted by interest rate rising. So all in all, really good year to the end of May, really strong start to the new financial year with the first quarter. All the metrics still pointing in the same direction. So on a numbers front, we move forward with cautious optimism. And with that, I shall hand back to Ed.
Thanks, James. So just by way of a summary and a bit of outlook, if we skip on to the last slide, thank you. So I think in terms of summary, we've simplified the structure, as I mentioned earlier, very much focused now on business to business lending, and very much own book rather than brokerages. We've had some key hires that we've embedded into the business, and they've proved to be very worthwhile hires. Our multi-product offerings expanded with the ABL products, and we see that as a key differentiator for the business moving forward. The hard asset and invoice finance businesses have definitely been the growth areas, and we see that continuing. Our arrears have been well controlled, and we see and hope that that will continue as well. And our profile within our space, our commercial finance space, particularly within our key broker network, has definitely increased and improved, and the brand recognition sort of demonstrates that as well. So I think that's a summary in terms of where we are against our plan, and generally things are tracking in the right direction. In terms of the outlook, well, it's very much continuing to focus on the current strategy. That's got about 18 months to run now. So this time next year, we will be sitting down, the senior team, and putting together a new cycle plan. Clearly that starts sort of well before then, but yeah, that's the timescales that we'll be looking to do that around. Momentum is still being maintained, and we see that continuing. We expect further growth on our key numbers in the second half of this year and over the next financial year, which takes us to the end of the current plan. And as I said right at the start of the presentation, that the market conditions do remain challenging, but that's where we believe there's opportunities. And certainly from my experience going through downturns and upturns as well, the products that we offer tend to do very well in times of boom and bust. They do okay in times of sort of static growth and activity, but they really come into their own in times of boom and bust. And that's partly because the bigger providers, like the banks, typically retrench, batten down the hatches, and opportunity comes out of those businesses. And that's certainly what we're seeing at the moment. So I guess that opportunity forms very much part of the investment case as well as the numbers. I would say the investment case for this business is very much around the opportunity and what we've delivered over the last 2 years, and how we see the business moving forward. But clearly the numbers back that up as well. So net tangible assets of over 35 million, but a market cap of 29. So the shares still trade at a discount. We have seen some very pleasing uplift in the share price over the course of the last week after we put out the latest market forecast, as James mentioned. and that expectation is now set at not less than 5.4 million pre-tax profit to take us through to May next year, and the existing figures that we've got out at the moment are 6 million to the following year, which will take us to the end of the current cycle. And we've had 4 great upgrades in the last 12 months. We did come out of COVID a little bit cautiously. Obviously, lots of uncertainty in terms of how the market was going to recover. As the government funding schemes ebbed away, businesses obviously returned to companies like ourselves. So we did have some cautious optimism. We remain cautiously optimistic because you can easily lose a lot of money in this business if you don't do things properly. We believe that the business is set up to do things properly and grow and take advantage of those opportunities that I've mentioned that come into the market in times where you've got high interest rates and higher costs. So as far as the business is concerned at the moment, we're in a good position and optimistic about the future. So that really concludes the presentation. So happy to take any questions.
Thanks very much, Ed and James. Very interesting presentation, and congratulations on the new strategy, which from what you've been presenting sounds like it's working very well indeed. So that's excellent. I'm sure shareholders will be very happy with that. Can I just remind all the delegates that if you have any questions, just click the Q&A button towards the bottom of your screen and type your question into the question box. So far, we've got a couple of erudite questions from Paul Lavin. So let's have a go at those. So the first question was, can you continue to internally fund growth and maintain that good growth over the next few years?
James, do you want to take that one?
Yeah, that's fine, Ed. Yeah, a good question, Paul. Very pertinent one we look at continually. But simplistically, the answer is yes. To hit the 4-year plan numbers, we believe we are cash generative enough to maintain, to not go out and need to raise money to hit those 4-year plan numbers to the end of May. So we think we can continue to grow to that 250 million or so with our own funds. That's very much the intention at the moment. And as Ed touched on, beyond that point, the 31st of May, we need to sit down and decide what the next 4-year plan is or 5-year plan, and we'll see where we go from there. But at the moment, the business can very much grow considerably and increase profits with the funding it has in place at the moment.
That's very good. Thank you. So another good question from Paul. Has competition in invoice financing picked up, and does that impact your ability to grow that segment? It's a popular area, invoice financing.
Yeah, I'll take that one. Thanks, Mark. Yeah, I mean, look, has it picked up? It's definitely picked up from where we were in 2021, immediately after the pandemic, because everyone was sort of sat on their hands and just looking after existing clients, really, rather than driving new business forward, because obviously the opportunities were few and far between, because most businesses tapped into the CBILS scheme or bounce back scheme that needed to get some loans into the business. Since then, the competition has definitely increased, but I would argue that it's no different than what it was in previous
prior to the pandemic.
Prior to that, it's always been a competitive industry. There's always lots of independents, small and larger banks, challengers as well that came into the market, and fintechs as well. So it is a competitive market, but nothing extraordinary than was in place prior to 2020 and the lockdowns that we went through. I think, as I mentioned in one of the early slides, we do definitely stand out from the crowd somewhat with our multi-product offering, and the ability to offer invoice, asset and loans is a big differentiator for us. There's not many of our independent rivals that can do that, and certainly not many that can do it quickly and seamlessly. And it's not easy, we're not completely there yet, but we're well on the way to making that as easy as we can for our brokers and our clients. So yeah, but I think the answer to that is Yes, competitive, but manageable, and we believe we're well positioned.
Well, thanks for already answering my supplementary question, which was going to be what's your competitive advantage? Great, well predicted, excellent. Okay, and we've got a question from Hugo here. He's rather keen to ask whether you're likely to increase the dividend. So what are the board's thoughts on that?
Well, that's relatively easy to answer because we have had this question a couple of other times in presentations we did at when we put our results out in September. We also had a question at our AGM around this last week, and we've got the December board as an agenda item to discuss the dividend policy. It is something that's been discussed previously, but we haven't discussed it more recently. So we'll be able to update more after that meeting. I think it's the 19th of December when the board meets to discuss that point on dividends.
So watch this space is the message.
Yeah.
Good, thank you. Okay. Again, I'd remind delegates, if you've got any more questions, please type them into the Q&A box. Otherwise, there are a couple of things that I wanted to ask. So firstly, what do you feel about the impact of the current economic climate on your clients and the increased interest rates that they're having to pay on borrowing?
Yeah, good question, Mark. It's an interesting one, isn't it? Because if we go back to pre-2008, this was sort of normal in terms of interest rate costs. So that was and I sort of started in the market in 1995. So, you know, 5.5, 4.5, that was just normal interest rates of what businesses borrowed money at. Of course, there's a whole generation of sort of new business owners, if you like, from the last 15 years that now think we're being charged or they're being charged a fortune. But history would say that that's not necessarily the case. And if you go back to sort of, you know, the late 80s, the cost of money was significantly higher than 4.5%, 5% that we were seeing in the 2000s. So I think obviously what we've had is a very false economy, if you like, in terms of the cost of money over the last 15 years. And I would argue it's back to something what we would class as more normal. That's not to say that it's not impacting on businesses, because of course interest rates has coincided with lots of other challenges that businesses have got in terms of supply chain disruption with things that are going on in the wider world. And we talk about supply chain disruption through the war in Ukraine and Russia, and people say, "Oh, really? Does that have an impact on your businesses?" And it really does. You know, we see typically you have conversations with businesses, and you know, I had one myself where you know, the wiring for a lot of the car industry came from factories in Ukraine, and that had a big knock-on impact to delays in vehicles. So, you know, there is a real impact in SMEs. People sort of think SMEs are, you know, not involved in big supply chains, but they absolutely are. You know, they're the heartbeat of what we do in terms of the business in the country. So I think the issue with interest rates is not on its own a major issue in my personal view. It's the other issues that businesses are facing: supply chain disruption, high inflation, in some industries, key shortage of staff as well, and obviously wage inflation as well. So it's that combination that means that businesses are finding it a challenge, but that's where they need people like ourselves to support them through that. And that's where I think we very much stand out from the crowd, because it's not, particularly in invoice finance, it's not just about supplying money as a commodity. It's about the service and the flexibility that you can provide them when they need some help. And that's something that absolutely isn't associated with the bigger banks anymore. And therefore we fill that void of you know, where some of those banks used to play.
Very good. Meantime, we've got a question in from Mark Lenshaw. So he'd just like to clarify the split in your business between asset finance, invoice finance, and loan finance was mentioned as well. Could you give an indication of that? And is it changing?
Okay, so the asset finance in terms of the lending book currently makes up around 60%. The invoice finance is about 35%, and the loan finance is 5%, so a much smaller element. We do want to see that invoice finance side grow, and it is growing, whereby it goes up to sort of 40-45%. But at the same time, we're still looking to grow the hard asset side, particularly as well. And there's a key difference there, without getting too technical. There's a key difference in terms of the two products and their growth. One is obviously a revolving facility, which is invoice finance. You lend money, but you collect money in. You lend money, you collect money in. Asset finance, if you're growing the business, you're typically lending more money out than you are collecting in. And certainly in the cycle of our business and the cycle of that book, it's a little bit easier to grow the hard asset business than the invoice finance business, because obviously one's a revolving facility and one isn't revolving quite as regularly at the moment. So that's a simple way of answering that. But yeah, very simply 60, 35, 5.
Fine, thank you. And then a question I wanted to ask on the marketing side. You mentioned in the presentation that finance brokers are important to you. I presume you also have a lot of relationships with accounting firms who small businesses usually go to for advice.
Yeah, we do. Again, the asset finance predominantly focuses on the broker market. The invoice finance has a much wider mix of introducers, and one of the key channels there is accountants, as well as general business consultants, ex-bank managers that go into some consultancy, insolvency practitioners, solicitors, turnaround consultants. It's a much wider spread of third parties, whereas the asset finance business is pretty much all broker driven.
So if you're seeking to build the invoice financing side, are you building your relationships with those alternative introducers?
We are, and that's one of the reasons why we've increased the sales team, because the sales team, business development is a key part of their job, and business development is going out and finding those relationships.
Good, that all makes sense. Well, congratulations once again, and we like management teams that continuously beat broker expectations. So well done, and long may it continue.
Thank you, Mark.
Thanks very much.
Certainly, fingers crossed.
Good. Okay.
Thank you.
Thank you both very much, and I'll say goodbye at that point.
Thank you.
Thank you.